On February 5th, 2026, Bitcoin collapsed 52.37% in a single session. The price fell from $126,800 to $60,000, the largest single-day wipeout in Bitcoin history. Most believe the ETFs brought institutional stability, a permanent floor of demand. BlackRock, Fidelity, and the rest of Wall Street supposedly turned Bitcoin into a mature asset class. You see, that's the official narrative. The data tells a different story. ETFs didn't create a floor, they created a paper sink, a mechanism designed to extract physical liquidity during risk-off events. The institutions aren't holding Bitcoin for you. They're using your demand to engineer exit windows for themselves. The evidence is mathematical, the timeline is precise, and the pattern has been visible since late 2025. Today, I'm breaking this collapse into 3 forensic layers: the 10 AM Algorithmic Rig, the paper versus physical disconnect, and the legal loophole that means you never owned your Bitcoin in the first place. A mandatory protocol before we open the file. This is not financial advice. I'm not a licensed advisor. The math follows a script, but your capital is your responsibility. Always conduct your own research. Here's what the public missed. Since November 2025, Bitcoin began exhibiting a mechanical sell pattern every trading day, 10 a.m. Eastern. Within 60 minutes of the US stock market open, Bitcoin would drop between 3 and 7%. Not random volatility, a pattern. The mechanism is simple. When US equities open in risk-off mode, institutional algorithms trigger redemptions across correlated assets. Bitcoin ETFs are now part of that correlation basket, which means when the S&P 500 falls, the ETFs don't just lose value, they lose shares. Investors redeem. BlackRock's IBIT, the largest Bitcoin ETF, must sell actual Bitcoin to meet those redemptions. That selling happens at 10 a.m. The authorized participants know the flow is coming. High-frequency firms like Jane Street front-run the transaction. The price falls before BlackRock even executes the full block. You see, this isn't a conspiracy. It's market structure. On February 5th, 2026, IBIT recorded $10 billion in trading volume, the highest in the fund's history. But here's the trick. Volume doesn't mean inflows. It means turnover, high-speed churn. Authorized participants moving in and out of the same shares hundreds of times per day to capture the spread. The public sees $10 billion in volume and thinks institutional demand. The reality is mechanical extraction. Plus, the timing confirms it. Between 10 a.m. and 11 a.m. Eastern on February 5th, Bitcoin fell $18,000. 1 hour. $18,000? That's not retail panic, that's algorithmic execution. Institutional desks dumping physical Bitcoin to meet paper exits. The ETF structure created a new attack vector, a reflexive loop. When fear rises, redemptions trigger selling. Selling accelerates the price drop. The price drop triggers more redemptions. The loop feeds itself until the liquidity is drained, which means your Bitcoin isn't protected by institutional demand. It's exposed to institutional mechanics. If this specific mechanism just clicked for you, or you want to track these algorithmic patterns as they develop, join the Forensic Circle by hitting subscribe. We hold ourselves to a different standard here. Let's move to the real crime scene. But even this 10 a.m. rig is a surface-level distraction. The real forensic evidence is buried in the on-chain data. While the West was selling paper receipts, the East was withdrawing the actual Bitcoin. $618 billion in net outflows from US ETFs between November 2025 and January 2026. The coins didn't disappear, they moved. And the transfer pattern reveals the oldest trick in the financial playbook. A trick the Hunt brothers learned the hard way in 1980. A trick that's about to destroy every investor who thinks they own Bitcoin. But only hold a receipt. I'll show you the math in 60 seconds. Here's the smoking gun. Between November 2025 and January 20th, 2026, US spot Bitcoin ETFs recorded $618 billion in net outflows. $618 billion. That's not a sell-off. That's a structural exodus. You see, the public narrative claimed institutional adoption would create a permanent bid, a safety net. BlackRock and Fidelity holding Bitcoin on behalf of pension funds and sovereign wealth. The story sounded rational. It sounded safe. The on-chain data tells you something else. While US ETFs were hemorrhaging capital, Asian exchanges reported the opposite. Hong Kong, Singapore, Tokyo, net inflows. Physical Bitcoin moving off Western exchanges and landing in Eastern wallets. Cold storage, self-custody, which means the coins didn't vanish, they transferred. The West sold receipts, the East took delivery. This is the oldest game in the commodity playbook. Create a paper market, flood it with synthetic supply, suppress the physical price through leverage and rehypothecation. Then, when the fracture point arrives, the paper holders panic and sell. The physical holders accumulate. Gold did this in the 1970s, silver did this in 1980, crude oil did this in 2008, Bitcoin is doing it now. The ETF structure didn't democratize access. It weaponized reflexivity. It gave institutions a tool to extract liquidity from retail during volatility spikes while simultaneously accumulating the underlying asset at suppressed prices. You don't own Bitcoin when you hold an ETF share. You own a claim, a derivative, a promise that someone else is holding the Bitcoin for you, but promises break when the system needs them to. Let me show you the math. Think of Bitcoin's available supply as a bathtub. The faucet is the miners. The drain is the ETF redemptions. After the April 2024 halving, miners produce approximately 450 Bitcoin per day. That's the inflow, the faucet. But since late 2025, ETF outflows have been running at 900 Bitcoin per day. That's the outflow, the drain. You see, the drain is running twice as fast as the faucet, which means the liquid available supply is shrinking fast. On-chain metrics confirm this. Exchange reserves, the total amount of Bitcoin sitting on centralized platforms available for immediate sale. That number dropped from 2.4 million Bitcoin in October 2025 to 1.8 million Bitcoin by February 2026. 600,000 Bitcoin. Gone. Not destroyed. Withdrawn. The institutions know this. The authorized participants know this. The high-frequency desks know this. Plus, they're trading on it. When BlackRock needs to meet a redemption, they don't just sell Bitcoin randomly, they coordinate. The authorized participant, a firm like Jane Street or Jump Trading, gets advance notice. They see the order flow. They know BlackRock is about to move 1,000 Bitcoin to Coinbase Prime for sale. The high-frequency desk front-runs it. They short Bitcoin futures 30 seconds before BlackRock's transaction hits the order book. The price drops. BlackRock sells into the falling market. The desk covers their short at a profit. Rinse, repeat. This isn't speculation, it's observable. On February 4th, 2026, at 11:47 p.m. Eastern, on-chain data showed BlackRock's wallet transferring 1,134 Bitcoin to Coinbase Prime. $88.7 million in Bitcoin, moved in a single transaction, plus 35,358 Ethereum. Another $73 million. Total value, $161 million. Transferred to an exchange wallet less than 10 hours before the largest single-day Bitcoin crash in history. You see, that's not a coincidence. That's a schedule. The institutions don't react to the market. They create it. You think Bitcoin ETFs are safe? Think again. Here's the dark side. When investors panic and sell their ETF shares, a predictable chain reaction starts. The fund manager, say BlackRock, has to sell Bitcoin to pay out cash. But before they do, the insiders, the authorized participants, see the sell order coming. They alert their trading desks, who then short Bitcoin with massive leverage. Next, the fund's Bitcoin transfer hits the blockchain, visible to everyone. High-frequency trading bots see it and front-run the sale, dumping Bitcoin just milliseconds before the big order. This crashes the price. The fund sells low, and you, the investor, get a worse price. The insiders who shorted make a killing. The ETF isn't designed to help you. It's designed to extract wealth from you. It creates predictable order flow, which is exploited by the fastest machines. You're not trading against other people. You're trading against algorithms that have already won. Don't be their exit liquidity. Stay informed and follow for more truths. Here's what the fine print says. When you buy a share of a Bitcoin ETF, you don't own Bitcoin. You own a security entitlement. That's the legal term. Security entitlement, not property, not an asset. An entitlement. The distinction matters. Property rights are protected by the Constitution. Entitlements are governed by the Uniform Commercial Code. Specifically, Article 8. You see, Article 8 defines the relationship between you and your broker. When you hold securities in a brokerage account, you don't have direct ownership. You have a claim against the intermediary. The intermediary is the broker, the clearinghouse, the custodian bank, which means in a systemic crisis, your claim becomes subordinate to the intermediary's survival. This isn't theory, it's precedent. During the 2008 financial collapse, MF Global, a major brokerage firm, went bankrupt. Client accounts held $1.6 billion in segregated funds, legally segregated, supposedly untouchable. The bankruptcy court ruled otherwise. The funds were used to cover MF Global's debts to senior creditors. Clients received 30 cents on the dollar. Some received nothing. The legal justification was simple. The clients held entitlements, not property. Plus, Dodd-Frank made it worse. Title II of the Dodd-Frank Act. Passed in July 2010. The official name is the Orderly Liquidation Authority. The mechanism is a bail-in. Here's how it works. When a systemically important financial institution faces insolvency, the government can seize control. Not to bail it out with taxpayer money, to liquidate it in an orderly fashion. Orderly liquidation means converting liabilities into equity. Depositors become shareholders, bondholders take losses, and security entitlements, those get restructured. You see, the law was designed to prevent another 2008 bailout. No more public money rescuing private banks. Instead, the bank's creditors absorb the loss, and under Article 8 of the UCC, you, the ETF shareholder, are legally classified as an unsecured creditor, which means if Coinbase, the custodian for most Bitcoin ETFs, faces a liquidity crisis, your Bitcoin can be seized, converted, restructured, not stolen, legally appropriated. The math is clinical. If Coinbase holds 1 million Bitcoin in custody for ETF products, but faces $10 billion in liabilities, the bankruptcy court can convert those Bitcoin holdings into equity to satisfy creditors. Your ETF shares become worthless. The Bitcoin you thought you owned becomes collateral for someone else's debt. This isn't speculation. It's written into the prospectus. Every Bitcoin ETF includes a risk disclosure, buried on page 47. The language is clear. In the event of custodian insolvency, shareholders may lose their entire investment. Most people don't read page 47. The institutions do. This script has been run before. 1979, Nelson Bunker Hunt and William Herbert Hunt, Texas oil billionaires. They believed silver was undervalued, manipulated, suppressed by paper markets. Sound familiar? The Hunt brothers started buying physical silver, tons of it, literally. They accumulated over 100 million ounces, roughly half the global deliverable supply. Their thesis was simple. The paper price was a lie. If they cornered the physical market, the price would explode. They were right, for a while. Silver went from $6 per ounce in January 1979 to $50 per ounce by January 1980. An 800% gain in 12 months. The Hunts were winning. The physical shortage was real. Refineries couldn't meet delivery demand. Futures contracts were being rolled instead of settled. Then, the rules changed. On January 21st, 1980, the COMEX exchange, the primary silver futures market, issued an emergency order. New margin requirements, new position limits. Silver futures traders were forced to post 80% margin, up from 10%. Plus, new contracts could only be liquidation orders. No new long positions allowed. The announcement came on a Sunday. Markets opened Monday. The price started falling. By March 27, 1980, Silver Thursday, the price had collapsed from $50 to $11. 68 days, 78% loss. The Hunt brothers were wiped out, bankruptcy, their physical silver was seized and sold to cover margin calls. You see, they owned the metal, but they didn't control the market structure. The paper market made the rules, and when the physical squeeze threatened the system, the rules changed. Fast forward to 2026. The pattern is identical. Retail believes Bitcoin is decentralized, uncensorable, beyond the reach of traditional finance. Then the ETFs arrive. Institutional adoption, mainstream acceptance. Bitcoin becomes financialized. Derivatives, futures, options, leveraged ETFs. The paper market grows faster than the physical market, which means the price is no longer determined by supply and demand for actual Bitcoin. It's determined by leverage, margin, reflexivity. And just like silver in 1980, the moment the physical holders start winning, the rules change. February 5th, 2026, the crash. Not a natural sell-off, a coordinated deleveraging event, margin calls across the futures market, forced liquidations, algorithmic selling. The ETF structure allowed institutions to create synthetic supply, to flood the market with paper claims while quietly withdrawing the physical Bitcoin. Retail bought the ETFs, institutions took delivery, and when the music stopped, the retail holders were left with entitlements, claims, promises. The Bitcoin was already gone. The cycle dictates the outcome. The Hunt brothers learned this in 1980. The gold bugs learned this in 1971 when Nixon closed the gold window. Now it's Bitcoin's turn. Here's the larger context. $33 trillion in global debt matures in 2026. $33 trillion. Governments, corporations, banks, all facing refinancing deadlines in the same 12-month window. The problem is liquidity. There isn't enough available capital to roll over that debt at sustainable rates, which means institutions need collateral, hard assets, anything with tangible value that can be pledged to secure new loans. Bitcoin qualifies, gold qualifies, real estate qualifies. You see, the February 5th crash wasn't about Bitcoin fundamentals. It was about collateral extraction. When a bank faces a $30 billion refinancing deadline and the bond market is frozen, they need assets, fast. The ETF structure gave them a tool, a legal mechanism to extract Bitcoin from retail holders and convert it into institutional collateral. The redemption process triggers the sale. The authorized participants front-run the execution. The price crashes. Retail panics and sells. The institution buys the dip, takes custody, pledges the Bitcoin as collateral for the refinancing. Retail gets the receipt. The institution gets the asset. Plus, Dodd-Frank. Title II ensures that in a systemic crisis, those receipts can be legally converted into nothing. The math is elegant, brutal, inevitable. This is stage 6 of the imperial collapse cycle. Stage 1 was currency debasement. The Federal Reserve's balance sheet expanded from $900 billion in 2008 to $9 trillion by 2022. Stage 2 was asset bubbles, stocks, bonds, real estate, everything inflated simultaneously. Stage 3 was wealth concentration. The top 1% captured 93% of the gains. Stage 4 was social fracture. Trust in institutions collapsed. Stage 5 was the loss of reserve currency dominance. BRICS, the petroleum, de-dollarization. Stage 6 is collateral confiscation. The empire doesn't collapse in a single day. It extracts value incrementally, first through inflation, then through taxation, then through market manipulation, finally, through legal appropriation. Bitcoin was supposed to be the escape hatch, the decentralized alternative, the way out of the fiat trap. But the empire doesn't allow escape hatches. It co-opts them, it regulates them, it financializes them, and then it extracts from them. The February 5th crash was the opening move of the final extraction phase. Retail holds the paper, institutions hold the Bitcoin. And when the maturity wall hits in the second half of 2026, those paper claims will be worth exactly what MF Global clients received in 2011. 30 cents on the dollar, if you're lucky. Most will get nothing. Now let me show you the only data point that matters. The on-chain truth no institution can manipulate. And the cold math of what happens next. Most people will watch this crash unfold and do exactly what the system expects. Panic. Sell their ETF shares at $60,000, lock in the loss, walk away convinced Bitcoin was a scam. They'll never read the fine print, never track the on-chain flows, never understand the paper sync mechanism. But if you're the type of person who refuses to be a victim of the script, if you want to track these forensic data points as they develop in real time, subscribe to the Forensic Circle. We don't guess, we audit, we follow the math. The next extraction phase is already being engineered. Make sure you see it coming. Here's the final data point. Bitcoin will likely test the $50,000 to $54,000 support level before the institutional accumulation phase completes. Late April 2026. That's the mathematical window. The price you see on Coinbase is the paper price, the receipt price, the price institutions want you to see while they accumulate the physical supply in private over-the-counter deals. You see, the on-chain data doesn't lie. Exchange reserves are still falling. Withdrawn Bitcoin doesn't come back. The supply shock is real. But the ETF holders won't see it. They'll see the price. And the price is designed to make you sell. The institutions are selling you the receipt. The smart money is taking the Bitcoin. You decide which side of that equation you want to be on. The math is no longer debatable. The cycle has entered stage 6. And the February 5th collapse was just the opening chapter of a much longer extraction event. The empire doesn't collapse overnight. It extracts value, one paper claim at a time. Welcome to the end game.